Hey everyone, welcome to this week's stock and macro update. So this week I want to start off by going over Tesla, and then I want to give a performance overview of the 21 Disruptors Index. Then I want to touch on a couple earnings reports that I've seen in the past week that I wanted to make a note of, and then I want to finish off by going over what I expect in the GDP report on Thursday. And just by the way, so everybody knows, Friday usually I do a crypto update, but this week, because of everything going on and earnings season, GDP, the Fed meeting next week, it's a really big time for the stock market. So instead of doing another crypto update, it's going to be a second stock and macro update for this week. So just wanted to give everybody a heads up for that. But let me go ahead and start with Tesla here. So they reported earnings last Wednesday. Overall, it was a really good report. They had 56% sales growth year over year. They still have so much room to grow. They only have 3.5 million cars on the road out of over 2 billion. So the market for their products, especially in U.S. and Europe, and to some extent China, is still extremely strong, and they have a lot of market to fill there. So a couple other things to point out: they decreased their overall debt levels by 47% and increased their cash by 37% over the past year. But the most important thing that I saw in the earnings report was their operating margin. So this was up a few percent, all the way up over 17%. And this is really, really high, especially for a car company. But of course, Tesla is not just an ordinary car company. I still consider them an energy company that just happens to create energy storage solutions for cars. But that operating margin is huge. And if you look at regular car companies, I mean, you get mid to high single digits, and then Tesla's all the way up at 17. So to see the operating margin growing is a really big deal, because as I've said, these past couple earnings seasons, this is where companies are getting hit by increased input costs like energy and labor. Operating margins for a lot of companies has taken a hit, but Tesla's continues to grow really strong. They also mentioned the possibility of a share buyback, $5 to $10 billion. Personally, I hope they don't do that, because they've got so much to do with that money in order to grow their business. I usually see share buybacks as kind of a waste of money. And yeah, I'm not a huge fan of that. So that's the one, I think, caveat of that earnings report. But overall, very, very good stuff. Just to give a quick performance review, over the past week, the Disruptors Index was up 5.72% versus the S&P, which was up 5.94%, NASDAQ up 6.79%, Russell 2000 up 3.97%, and ARKK up 4.24%. So, and I don't have the Dow listed here, but the Dow might have actually outperformed everything there. There were a lot of value stocks up, especially Friday and Monday, when I think there was kind of a rejuvenated hope of a Fed pivot. And it was a weird rally because, first of all, Friday was an option expiration date, so you can never really, you got to take those with a grain of salt, whether it's up or down. But the VIX was actually up between Friday and Monday as well, when the S&P was up around 4%. So it seemed kind of like the VIX wasn't buying the market rally, and also some weird areas of the market were rallying, like consumer staples and banks, insurance companies, things like that. So growth kind of took a back seat to that, so definitely want to keep an eye on what the market does going forward here as we get into earnings season as well. But looking at our portfolio, the top three performers over the past week were Energy Fuels, which was up 14.85%, Levent Corp up 12.39%, Cameco up 12.12%. So our two uranium plays, Energy Fuels and Cameco, and our lithium play, Levent. So the commodity players were leading the portfolio higher. Good to see strength in those, because again, when growth stocks are down, these can sometimes serve as kind of a balancing effect and balance out the portfolio, because they're not really correlated to growth stocks. So that's why we have a few of those in there, and also, of course, super bullish on the future of these commodities as well. The bottom three performers: Plug Power down 12.76%, Guardant Health down 12.39%, and Bitcoin actually was up 0.92%. So only two of our stocks were down over the past week, which is also really good to see. And just to give kind of an update on what I'm going to do on Friday is I'm going to have a bunch of earnings updates for us with companies in the 21 Disruptors Index. So Cadence Design reported on Monday, Enphase reported yesterday, and Teladoc reports today. So all three of those will be in the Friday newsletter. So just to touch on a couple other earnings reports. First, Procter & Gamble, and both of these companies are companies that are in severe trouble and examples of what you should stay away from in the market. So Procter & Gamble's sales were up 1.35% year over year, obviously negative growth when you account for inflation, and their EPS were actually down on a nominal basis 2.48% over the past year. Looking at their cash, their cash balance is down 35% over the past year to $6.71 billion, which sounds like a lot of money, and that should be able to last a company like Procter & Gamble a decent amount of time. But of course, they're blowing all their extra money on dividends and share buybacks. So in Q3 alone, they spent over $6.25 billion on these two areas. So if they do that for another quarter, that's like their entire cash balance. And I know they make cash flow through operations and things like that, but still, that's a relatively huge amount of money for them to be doing in one quarter. And they essentially bought back 3% of the company through share buybacks. I think they spent $4 billion on buybacks just in Q3 alone. So obviously they can't keep this up, because if they did, they would run out of cash in probably a year or less. So the fact that they're doing this and they're not going to be able to continue it for very long is going to, number one, probably deter shareholders. I mean, they're already seeing negative real growth quarter after quarter. So when they dial back the dividends and share buybacks, that's going to be bad for shareholders. And also, it's going to remove a lot of buying pressure from the stock. Like I said, they bought back like 3% of the company, and essentially they're their number one source of demand. So it's not looking good for Procter & Gamble, both fundamentally and also with supply and demand for their stock. Next is Whirlpool. So obviously, a weakening housing market is bad for a company like this that sells durable goods, home appliances, things like that. Their sales were down 13% year over year, but their EPS is down 33% year over year, and essentially that's their profits. So both of those are down significantly on a nominal basis, and even worse, of course, on a real basis. Their cash is down 37% over the past year as well. But they're still doing the same thing as Procter & Gamble. They're spending a ton of money on dividends and share buybacks. In Q3, they spent $165 million on these things. And so far this year, which is just 3 quarters, they've spent almost $1.2 billion altogether on dividends and buying back their stock. And $1.2 billion, that's over 14 times their total profits for the year. So the priorities just don't seem to be right there. So that's what I'm seeing for these companies. Again, these are examples of what to stay away from. We want to stick to companies that have a lot of cash, good cash flow, and are using that money to grow their company rather than pay out dividends and share buybacks, and also companies that have relatively low debt. A lot of growth companies actually have really, really low debt and high cash. So that's what makes growth stocks still really attractive to me. GDP, so the Q3 number is going to be released tomorrow, the same day as Apple, Amazon, and a couple other huge companies are reporting. And the Atlanta Fed estimate, which is kind of the widely circulated one on financial media, is at 2.9% growth for Q3. And I'm not convinced that that's going to pan out. It might, but I want to share some reasons that I think that we could be in for a negative surprise, kind of like Q1. So over 70% of GDP is the consumer. So it's measured by personal consumption expenditures, which is PCE, which is also one of the ways that we gauge inflation, which is PCE growth. So if the consumer isn't strong, it's going to wear on the overall GDP number. And we don't have obviously the Q3 PCE yet. That's going to be released with the GDP data, but we do have retail sales data for Q3. And if you look at retail sales on a real basis, meaning adjusted for inflation, the retail sales were actually down 0.74% in Q3. And if you take the average PCE, real PCE for July and August, it's up about only 0.13% from Q2. So the consumption for Q3 doesn't look too strong, but even more than that, what could really be a wild card for Q3 GDP is inventory levels. And this was already, this has been up and down like crazy over the past year and a half or so, or 2 years, just because of the whole, lockdown situation, the bullwhip effect with companies having inventory shortages and then way over ordering inventory. When inventory grows, and this is measured through private inventories, that's the official GDP measurement. When inventory grows at a rising pace, it adds on to GDP. When it grows at a slowing pace, it can subtract from GDP. So we've seen huge GDP adjustments because of inventory. So in Q3 of 2020, GDP was actually increased by 7.57% just that quarter because of the rising inventory levels. And actually, at that point, inventory wasn't even rising, it was just decreasing at a way slower rate. In Q4, inventory went up at a faster rate, so it was increasing at an increasing rate. And in Q4 2021, it added 5.01% onto GDP. So this can have a huge effect. It can take a GDP that's down 3% and push it all the way up to positive 2%, which is, can create much different opinions and expectations about the overall economy. So, like I said, they use private inventories. Obviously, we don't have the data yet. That's going to be released with the overall GDP report. But we do have total business inventories data for July and August. And the past 3 quarters, inventories have gone up $930.8 million, which is about an average of $103 million per month. And it's been a pretty steady increase. I think it was like 230 some million in Q4 of last year. And then each quarter so far this year, it's been over $300 million worth of inventory increase. But between July and August, the total increase of inventory has only been about $33.1 million, which is way lower, which suggests that inventory is increasing at a way decreasing pace. So it's kind of like the inverse of Q3 2020, where inventories were still down, but they were down way less than Q2 because Q2 was kind of the lockdown quarter. Now we're in the reverse, where inventories have spiked for a year or 2 years at this point, and now we're finally starting to see that the beginning of the top. Not saying it's the top yet, but I think we're seeing the beginning of the topping out process for inventories, and that is going to, I think, have a pretty negative effect on GDP for Q3. So I go more into this in detail into this in the Substack. So if you want to look at that to get some more details, I would recommend doing so. But that's really the overview I wanted to give of GDP this week. Again, next week I'll go over the GDP report in depth and go over why it's up or down more than estimates, and also go over some more earnings reports from our portfolio. But as for this week, that is all I had. So thank you everybody for watching, and I will see you again on Friday.